Welcome to this advanced lecture on the balance sheet, or as it's formally known under IFRS, the Statement of Financial Position. This is not your basic accounting overview. We're diving into the fine print, classification logic, recognition criteria, measurement bases, standards compliance, financial analysis, and common pitfalls. Conceptual definition and purpose. A balance sheet is a financial statement that presents the financial position of an entity at a specific date, detailing its assets, liabilities, and equity in accordance with the accounting equation. Assets equals liabilities plus equity. Under IAS 1, Presentation of Financial Statements, IFRS, this document is required in every financial report. Under ASC 210, US GAAP, similar requirements apply but differ in formatting and classification conventions. Objectives: communicate solvency, liquidity, and financial flexibility. Provide inputs for financial ratio analysis and credit risk assessment. Serve as a foundation for valuation models, e.g., NAV, EVA, DCF balance sheet-based inputs. Assets: IAS 38, a resource controlled by the entity as a result of past events and from which future economic benefits are expected to flow to the entity. Classification: A. Current assets, recoverable within 12 months. Cash and equivalents, includes treasury bills, money market funds, bank balances. Trade receivables, measured at amortized cost, net of expected credit losses, ECL under IFRS 9. Inventories, measured at lower of cost or net realizable value, IAS 2, using first in first out or weighted average. Short-term investments, held for trading. Prepayments, insurance, rent, etc. B. Non-current assets, long-term usage. Property, plant and equipment, PPE, recognized under IAS 16, measured at cost or revaluation model. Intangible assets, trademarks, patents, goodwill, IAS 38. Goodwill is tested annually for impairment under IAS 36. Investment property, IAS 40 allows cost or fair value model. Deferred tax assets arises from deductible temporary differences, IAS 12. Liabilities, IAS 37, a present obligation arising from past events, the settlement of which is expected to result in an outflow of economic resources. Classification: A. Current liabilities. Accounts payable, measured at amortized cost. Accrued expenses, salaries, taxes, interest. Short-term debt, commercial paper, overdrafts. Current portion of long-term debt, reclassified from non-current. Provisions, legal claims, warranties. IAS 37 requires a reliable estimate of the obligation. B. Non-current liabilities. Long-term debt, bonds, term loans. Deferred tax liabilities from taxable temporary differences. Lease liabilities. Per IFRS 16, all leases, except short-term, low value, are capitalized. Contingent liabilities, disclosed unless probable and measurable. Equity. Definition: the residual interest in the assets of the entity after deducting liabilities. Components: share capital, ordinary and preferred shares at par or no par value. Share premium/additional paid-in capital, excess over par. Retained earnings, cumulative net income less dividends. Other comprehensive income, OCI. Revaluation gains, foreign currency translation, unrealized gains on FVOC instruments. Treasury shares, deducted from equity. IFRS versus GAAP. Note: under GAAP, OCI is sometimes presented in a separate statement. Formats and presentation rules. S1. No prescribed format. Requires clear classification into current, non-current. Flexibility in line items. Can aggregate or disaggregate based on materiality. US GAAP, ASC 210. Prescriptive classified format. Classified versus unclassified formats allowed. SEC registrants must follow Regulation SX, Order of Liquidity, IFRS, assets listed from least to most liquid. GAAP, usually most to least liquid, cash first. Recognition and measurement bases. Recognition criteria. It is probable that future economic benefits will flow to or from the entity. The asset or liability has a cost or value that can be measured reliably. Measurement methods. Historical cost. Amortized cost. Fair value, IFRS 13. Net realizable value for inventory. Present value of future cash flows, e.g., for provisions or leases. Financial analysis using the balance sheet. Common ratios. Ratio formula interpretation. Current ratio. Current assets divided by current liabilities. Liquidity measure. Quick ratio. Current assets minus inventory. Divided by current liabilities. Immediate liquidity. Debt to equity. Total liabilities divided by equity. Leverage and capital structure. Equity ratio. Equity over total assets. Long-term solvency. Return on assets, ROA. Net income over total assets efficiency in asset use. Working capital. Current assets, current liabilities. Operating liquidity buffer. Horizontal and vertical analysis. Horizontal. Compare line items over time to analyze growth or deterioration. Vertical. Convert balance sheet into percentage of total assets for benchmarking. Risks, judgments, and estimates. Judgment areas. Lease classification, IFRS 16. Intangible asset recognition, internally generated. Provisions and contingencies. Depreciation methods and useful lives, PPE. Estimates. Impairment testing, IAS 36. Credit loss estimation, IFRS 9. Pension obligations, IAS 19. Risks. Overstated assets through aggressive capitalization. Underreported liabilities. Off-balance sheet. Equity manipulation via share buybacks. Conclusion and call to action. The balance sheet is not just a static snapshot. It's a lens into the operational, financial, and strategic backbone of an entity. Its components affect valuation, debt covenants, compliance, taxation, and investment decisions. If you are happy with our content, like and subscribe, and don't miss our accounting content. Our next video will talk about income statement in detail. Thank you for watching.